Good afternoon, everyone, and welcome to this special webinar on shared ownership. My name is Linda Clark. I am the editor of First Time Buyer, and today I'm joined with some fantastic experts who are going to explain everything you need to know about shared ownership. This week is actually all about shared ownership. It's called Shared Ownership Week, believe it or not. And it's a one-stop shop for basically people to find out everything they need to know about how this government scheme works, how it helps you to get onto the ladder, and how it is a very affordable option for first-time buyers. So I'd like to introduce our panel. Sadly, we've got technical problems. Hasn't everybody in the world got technical problems? But Helen Fairbrother, who is South Sales Manager for Guinness Homes, is here, but unfortunately we can't see her. But she's definitely there. Hello, Helen.
Hello, Linda. Hello, everyone.
Thank you. Thank you so much for joining us. We also have Tony Harker, who's an independent housing consultant. Hello,
Hi,
Tony.
Linda.
Hello.
Hi, Linda.
And Anthony Hall, new business director for Sensio Financial.
Hi, Linda. Hi, everyone.
Hi, thank you so much. So, yeah, shared ownership is a fantastic way to actually buy your first home. It's been around for many, many years, and we're celebrating it today with this discussion about how, as I say, how it works, what you have to do. So we'll kick off with the first question, please, Katie.
So how does shared ownership actually work?
Good question. So, Tony, can you give us an overview of what it actually, how it works?
Yeah, sure. I mean, as you quite rightly say, Linda, shared ownership's been around for years and it's helped thousands of people get onto the property ladder, which is amazing. And that is a very popular product. Shared ownership is basically part buy and part rent. So with shared ownership, you'll buy a share in the property, which is usually initially between 25 to 75%. And that's based on an affordability assessment with a mortgage broker like Anthony, who will then assess how much you can afford using your savings and a mortgage. You'll then pay a rent on the unsold share, and that's usually up to 3% of the unsold share, which is paid in 12 equal monthly payments. And then finally, there is a payment for service charges, which is for the building and communal areas and the estates for the repairs and maintenance of the building that you're actually going to live in.
Yeah, it's pretty simple, really, but obviously, you know, a lot of people are very confused about it. Anthony, getting a shared ownership mortgage is just the same as getting a mortgage for any other type of property that you're going to buy on the open market or through Help to Buy?
Generally, yes. So what you will have is mortgage advisors like Sensio who specialize in affordable products like shared ownership. So there are not the same amount of lenders. So you do have high street lenders, you have some building societies and some specialist lenders that will do shared ownership. The main difference is the way how the underwriting is done, because you do have things like Tony said, the rent and service charge that need to be taken into consideration. So our advice always is that try to speak to somebody who specializes in shared ownership mortgages. Although any broker can potentially place you with a mortgage, or you can go to your bank directly, it is a lot more easier if you go through a specialist. A prime example is NatWest as a bank, sorry to call their name, but they do Help to Buy mortgages, but they don't do shared ownership. So if you bank with NatWest, that might be your first point of call, but they're not necessarily going to be able to help you with the shared ownership scheme.
Right, okay, that's very interesting. I didn't realise that about NatWest. So let's go on to our next question, please.
So you mentioned shared ownership mortgages. So when I get my mortgage for my shared ownership home, is my mortgage for the share amount or for the full property?
Helen, can you start us off on that one?
Yeah, absolutely. Thanks, Katie. That's a really common question that we're asked quite frequently. So let's start sort of with the basics. When you've chosen the property that you want to buy, you will have a financial assessment by one of the listed financial advisors on the Affordable Housing Providers Panel. Now, they'll determine the share that you can afford to buy and the share that you can afford to sustain. Now, at the moment, the minimum share that you can buy is 25%, and you'll work with your financial advisor to secure a mortgage based on the share that you can afford. Generally, lenders will require you to have a minimum of 5% deposit of that share and offer you a mortgage of 95% against the remainder of that determined share. And I guess it goes without saying that the larger deposit that you can sort of fund or find will open you up to sort of a greater panel of lenders offering you a sort of a wider, much more attractive variety of rates.
Yeah, that's very good. Anthony, have you got anything to add to that?
Yeah, I would just like to add that the way how it would work in terms of a deposit is that the lender will look at the actual share amount. And as Helen said, you can put down a minimum of 5%. But then the advantage of shared ownership essentially is that if to put down a 20% deposit on a share is going to be a lot better than putting down 20% on a full market value, especially when you're looking at new build, because a lot of the lenders require a bigger deposit on new build, especially on the high street. So you might be looking at a 15% deposit plus. So if on the open market, that might not be feasible for somebody to buy a new build property, but it is then possible on shared ownership.
Yeah, very true, very true. So Tony, shared ownership is only available on new builds. We'll talk about resales in a bit, but is it, you can't just go down and look in an estate agent's window and find a second-hand home and buy it through shared ownership?
Well, no, there is actually people who want to sell the property. It's very much like anyone buying a property on the open market. That's what the estate agent business is all about. And likewise with shared ownership, people want to move. For all sorts of reasons, they need to move. And they have the ability to do that using what we call in the terminology this industry uses, which there's lots of, we call it a resale transaction. And you will have requirements within the terms of the lease in which we have to deal with that resale transaction for you.
Right, absolutely. Thank you. Let's go on to another question.
Can I use shared ownership if I've previously owned a home?
Oh, Helen, can you have a shared ownership home if you've already owned a home before?
Yeah, Linda, there's a bit of a misconception around this question, and it's a really, really interesting one. And the misconception is that shared ownership is only for first-time buyers. And what we're seeing, and it's probably due to what we've all been through, I guess, over the last sort of circa 18 months, is that there are changes in many people's lifestyles and sort of living arrangements. Yeah, you can buy a shared ownership home if you've owned a property in the past and it's sold, or indeed if you own a property now, and whether that's an open market home or a shared ownership home. But however, you must have completed on that home at the time of completing on your new shared ownership property. So, and I think really what I ought to add in here is that you are not allowed to own a second home either in the UK or abroad.
Right. Yeah, that's very important. Absolutely.
Yeah.
So, I mean, people have different circumstances as to why they need to move on. Even if you've lived in a property before that you've owned. Yeah, that's great. Anybody got anything to add to that? I think it's probably answered it. No, I think we've done that very well. Thank you. Another question, please, Katie.
How much can I borrow for my mortgage, and what documents do I need for my application?
This is one for you, definitely, Anthony.
So the amount that you can borrow is going to be subject to an individual assessment. So when you're buying shared ownership, especially new builds, you'll have to go through an affordability calculation where the advisor will look at the amount of commitments you have, loans, credit cards and such things, and the level of deposit that you have. and your income, that will determine the amount of share that you can buy. So the minimum share, as Tony said earlier, is 25% and the maximum 75%. But what the advisor will do is calculate, using this affordability calculator, what actual share you can actually purchase. So that maybe 40% is the share that is deemed affordable, and then the mortgage will be based against that share. And then we would then have to go to a lender who will be able to lend that amount to purchase the initial share. Once we've done that, what your broker will do is go through documentation. So to assess you, you'll need to have 3 months pay slips if you're employed. If you are self-employed, you will need to have accounts if you're a limited company for the last 2 years. And as a sole trader, we'll look for what they call SA 302s for the last 2 years. And that will show what your net profit is. And then also what a lot of the lenders ask for now is something called tax overviews, which shows how much tax you've paid over the last 2 years as well. Bank statements are required. Typically, it's the last 3 months. Sometimes they can ask for more bank statements, but generally it's 3 months bank statements, proof of your identity, and then also evidence of where your deposit has come from. So if you're getting a gift from family or friends, you will need details of their statements to show where that money's come from, as well as identification for money laundering purposes. Those are the sort of main things that are required, but depending on your circumstances, more documents can be requested at the beginning. Likewise, once you start a mortgage application, a lender does reserve the right to ask for more documents.
But you are very much in a hand-holding situation, aren't you, Anthony? People shouldn't be scared and thought, oh, I don't know about all these documents. I'm sure that your advisors are there to help them to, you know.
Exactly. So what we actually do is we work with the registered providers, the RP and developers, and we give a list of documents that are actually required before they actually see us. And likewise, when they're booked in to see an advisor, they are given a list of documents to bring, also links to where they actually can get the documents as well. So things like credit reports, you know, you can get, if you haven't registered with a provider, you can get free trials. So it doesn't cost you anything to get your credit report for 30 days. So there are little tips that we do provide. And as you said, we hold people's hand all the way through the process. And I think the key thing is organization. I always say to people, before you even put a reservation down or you go and see a property, is that you start to get together all your documents, your bank statements, your pay slips, and so you're prepared. So when the advisor then says, I need this list of documents, it doesn't then become overwhelming for you.
Absolutely. What good advice. Yeah, just get a folder and put them all in and just make sure that you've got them all together. It is, because it's sometimes you need time to find these things, you know, they're...
Exactly. And also printing. A lot of people don't have printers or scanners. So it can take time, and that's probably the hardest thing at the moment, especially if people are working from home, they might not have access to a scanner. And you know, the format of documents is important as well, because ideally, if you can get them in PDF format, that is ideal, because when we're uploading stuff to lenders, it makes everyone's life a lot easier and the process quicker.
Lovely. Absolutely. Really good advice. Thank you. Great. Another question, please. What
are service charges and how much should I expect to pay?
Oh, Tony, could you help on this one?
Yeah, sure. Right, what service charges are? It's a sum of money which basically covers the share of the costs of repairs, maintenance, and the services of your building, and usually the communal areas as well. But it can also include the external landscaping and estate maintenance charges. So in terms of, you'd need to check your lease and to ask the salespeople what is actually covered in there. But in general terms, the cost includes things like cleaning and maintenance of the communal areas, communal lighting, water, heating, any solar panels that are on the roof, caretaking, security, concierge, lift maintenance. There's so many different things that we don't even think about on there. Grounds maintenance. Then there's things like bulky refuse removal. If one of your neighbours leaves some rubbish, that's got to be removed away. Bin hire, fire ventilation, health and safety issues, fire safety checks, buildings insurance, and a reserve fund, which is basically for cyclical repairs and major works. To give you to try and give you an example of this, I'm just picking up on a question that's come through from Wayne there. Are shared ownership homes sold without service charges? All properties within shared ownership will have some element of service charge. As I said, there's a house can still have a service charge because there's estate maintenance costs and various things like that. So there will be, but usually a house is a lot cheaper than a block of flats. It is important to remember as well that it depends what services your particular flat offers, and this needs to be considered when you're actually looking at a property to buy, because service charge can vary dramatically. Very quick example, if you want to be in a block of flats that has a concierge, and you want that concierge that's going to operate for 24 hours a day, generally we all work 7 hours a day. So that means you need 3 to 4 people per day to cover that service for you. And that's salaries, holiday, sickness, all those sorts of costs have got to be incurred. So if you want that service, it's going to cost more for you to actually have that service. Every building is different. So it's very hard to actually give very estimate costs on there, but generally speaking, if you're in a 1-bedroom flat in the London area, you're probably paying around £125 per calendar month. 2 beds, 150 maybe. But it really does depend on the service, and all I can really advise you is to really look at that when you're looking for the property and understand what the service is, and what services and facilities you're going to get from that.
Absolutely. What about things, do service charges also look after things like, supposing there was something gone wrong with the roof, they always have a bit of a reserve fund?
Yeah, they have the reserve fund. Some people call it sinking fund. It's got a few different names in there. That's mainly for cyclical works or major repairs that are needed to the property. So it's a build-up of a fund. It's held in a separate bank account, and that then is a fund that goes towards paying off the major works. It's quite technical, is all the way that we go about this, but any major works, you will be informed and asked to, you'll be consulted in those fees, dependent upon the nature of it, how long that will be to actually, before the work is actually carried out, unless it is an emergency.
Right, great, thank you, very good. Let's move on to another question.
Are all fees, such as the service charge, included in the rent I've been quoted, or are these separate costs that I should consider?
Tony, that's probably back to you again.
Yeah, right. What is very important is the rent is for the unsold share in the property that you're not buying with the mortgage and your savings. The service charge is separate from that. So it's not included in the rent. Generally speaking, though, most of your housing providers will collect the rent and service charge in one payment every month, and then it's split out accordingly. But then it is a separate payment. And if you look at, I'm trying to think, I think nearly every organisation that I've ever worked for or that have been involved with, they all show on their price lists the approximate cost of the rent and also the service charge separate. So that should be very clearly identified to you when you're looking.
Absolutely. I'm just looking at these questions that are coming in very quickly, Anthony. Somebody's saying, I've got an HSBC current account and a Monzo account. Do I need statements for both?
Yes, we would need to see both statements of if there's transactions coming in and out. Initially, what first we would want is the bank statements where your salary goes into. That would be a must. But then if you have a second account, which you've got transactions coming in and out of both, then we would require 3 months for that account as well.
Lovely. And just one other one quickly. Somebody's written, it was interesting to hear that mortgage lenders require a bigger deposit on new builds. Why is that?
So following the crash in 2008 from the credit crunch, a lot of the lenders decided that they would put basically a what's the word, a little bit of buffer in terms of risk, because the new build market, there is a premium. It's like very much buying a brand new car, because it is brand new. There is a little bit of a premium that you pay for it. So that premium can be eroded if there's a fall in valuations. So if there is a crash in the housing market, it is the new build properties that are going to feel it first, because they have the premium. So what lenders do to give themselves some insulation against that, they ask for a slightly bigger deposit. But it is nothing to worry about, because within the shared ownership market, we have 15 lenders that will lend up between a 10 and 5% deposit. So we have enough lenders that will lend with smaller deposits. It's just that, like I said, mainly the high street lenders will want sort of 15% deposits and above.
Right, lovely. Well, 15, that's quite a good choice, isn't it, really?
Yes, and that's improving, I must add. It's actually better now than it was before the pandemic. So we've always had around between 8 and 10, and that has climbed up to 15 as of this week.
Very interesting. Gosh, that's good. Things are on the move. That sounds back to a good state of affairs.
Yeah.
Another question, please.
What is the eligibility criteria for the shared ownership scheme?
Oh, Helen, could you help us out with that one?
Yeah, absolutely, Linda. Well, obviously, first and foremost, you need to be over 18. I think that probably goes without saying, but a bit of a belt and braces sort of approach there, just to cover that one off. The priority group thereafter are current or former armed forces personnel. And so they are the main priority group. And then it's about not being able to afford a home on the open market that would be suitable for your needs. And then it's looking at those maximum household income thresholds, £80,000 maximum household income for outside of London, and 90,000 for within London. As I referred to earlier, this must be your only home, either here and abroad. And of course, you will need a healthy credit score to enable you to get the mortgage in the first place. And furthermore, to sort of demonstrate that you can sustain the mortgage and all the other associated costs, such as the service charges that Tony was sort of mentioning just now, and the rent and the household bills and expenses that go with sort of running your own home. Having said that, Linda, you might find that certain areas do have local priorities, such as live or work, or perhaps in some cases live and work in that area. So you really do need to look at the development that you're interested in and actually have a look at that eligibility priority list, speak with the sales advisor, who'll be able to really inform you about the priority.
Absolutely. Yeah, I think it's, the everything we're talking about here, it means ask lots of questions.
Lots.
Without asking the questions, you'll just never really find out exactly what is right for you. So that would be my advice, isn't it? Always ask lots of questions.
Might I add something on this one, Linda? I think what Helen said is exactly what the advisors do to make sure that people, do qualify from an affordability side of things. But also, we also check if somebody is too affordable. So we also want to make sure that they're not in a position to buy that same property on the open market.
Right.
So you can be overqualified if there's such a thing to buy shared ownership, even if you are under the income cap. But if you've got access to a very large deposit, for example, and with your income, you're able to buy that property outright, we wouldn't be putting you forward to buy shared ownership.
No. So let's just repeat what the actual income cap is inside London.
80,000 in London is 90,000, and outside of London, 80,000.
And is that for joint income or a single? How does it work?
It's based on household income, so it would be joint. So whatever the household is earning, the total can't exceed those income caps.
Right, absolutely.
Linda, it is just also worth mentioning, sometimes within the planning obligations that some of the local restrictions will put income caps below those in place for a short period of time as well. So sometimes people have to wait. Like the local restrictions that Helen mentions, it might be for a 3 or 6 month period. So sometimes you do have to, you do fall outside that priority group and have to wait a little bit longer. Just finally as well on that, with the armed forces, there's certainly, I'm not going to go into all the detail of that, but it is the regular services of the Army, Navy and Air Force. It's some clinical roles, it's some Ministry of Defence police officers, and it's some uniformed Defence Fire Service staff. But it also includes some ex-forces people who've actually left the armed forces and have been discharged for up to 2 years, and also those partners who sadly lost the partner can actually also qualify.
That's really good to know. Yes, that's really good to know. I'm glad that we can at least help. I mean, they do an amazing job, everyone that you mentioned there. So yeah, that's brilliant. Great. So let's go on to another question.
We have heard that there are some changes to the minimum share. Could you explain what these are?
Yes, now this is all getting very complicated, so I'm going to hand one over to Tony.
Okay, right. Yeah, that is correct. Now, this is a little bit complicated to explain, so I'm going to have to take a little bit step back on this. So for a housing association, a housing provider, with it council or whoever, they're able to take advantage of grants from the local government, from government, to help build affordable homes. Now, these grants actually fall into periods of time, and we're currently just entering the period of the 2021 to 26 period. And in that time, there has been some changes made to the grant funding. And one of those is that the minimum share that we told you about was 25%, will drop to 10%. The thing is, you're not probably going to see those homes come available immediately, because obviously the funding is there to build the homes, and it takes a year, 2 years to actually build those before you will actually start seeing them through, unless maybe some housing association have been able to buy some off plan and use some grants. But the best thing to do is to always look at the affordable home portals, and they will actually show the minimum share that's available on that particular scheme. And in some instances, maybe some providers will be actually offering lower than that 25%. You've really got to look, it all depends on the scheme and how it works out. Housing associations have got to make that scheme work to be able to deliver the home. So it's quite a complicated process to go through.
Absolutely. I think it's to watch this space. And as you say, do your research, have a look and see what, as you say, always will tell you how much the minimum share is. So you just have to hunt around a little bit. Just one thing before we go on to another question. This is another quick one for you, Anthony. People that have got a bad credit rating. Now, there are ways, we're not credit people here, but there are ways to sort that out, aren't there?
Yes, I think what I would always encourage is to obtain a copy of a credit report, like I said earlier. So you know exactly what situation you're in. So there's a difference between having a bad credit score and actually having adverse history. So adverse history would mean you've had a CCJ or a default, or you've entered a debt management plan. You can have a poor score if you're not on the electoral roll or you haven't had much credit. So what I wouldn't do is get discouraged if your score isn't 999. The best thing to do is to speak to a mortgage advisor who will be able to tell you what your options are based on the actual history and score you have. There are lenders that don't take into account credit scores. They will just look at the conduct of your previous credit. If you haven't had any credit before, then they'll just base it on, your income and your spending habits from your bank statements. So if you do have a bad score, it doesn't mean that you're not going to be able to obtain a mortgage. If you have had adverse history, like I said, defaults and CCJs, likewise, every bank and building society has a different criteria and policy as to how they will deal with that history. So if it was 4 years ago, for example, it might be waived and it might mean that you can get a mortgage. If it's more recent, then it's probably unlikely. What I would say is any sort of outstanding bad credit that you have, if it hasn't been paid and settled, try and do that as early as possible, because that would put you in better stead when trying to approach a lender.
Absolutely. And get on the electoral roll. That is so simple.
Yeah.
Yes, indeed.
Linda, sorry, just a very, very quick one here as well. When properties are advertised on the portals, it often, there's a question in there that's quite relevant at the moment. It actually shows the minimum income required, but it's often based on the minimum deposit. So what you've always got to do, and what I'd always recommend you do, is have a word with one of the financial advisors. So if you're interested in a scheme, contact the people like Sensio, and actually there's other brokers out there as well, and have a chat with them to see what your circumstances are. Because if you have got a bigger deposit, then you need less income.
Yeah, absolutely.
And that just might help a question that's just come in as well.
Yes, I saw that. That's really good. Thank you, Tony. It's very good.
But likewise, that has an impact on the sort of credit element as well. So if you've got a bigger deposit, you're more likely to be accepted, because, as I said earlier, with regards to new build, the lenders work off risk. So the bigger deposit you have and the less they have to lend against the share, the lower the risk you are. So it's all put forward, the better.
Fantastic. Great. Thank you. Lovely. Another question.
How often would I usually hear from my mortgage advisor?
Wow. How often would you normally hear from a mortgage advisor?
It really depends on what stage you're at. I think typically the journey is that you'll have an initial meeting with an advisor and they'll do the initial assessment, and that will sort of tell you whether or not you qualify for the property. Once you've been allocated and you've put down any reservation, the advisor will be in contact to start the application process. Typically speaking, we will be in contact with you pretty much every 48 hours to provide an update. But different lenders have different processing timescales. So if the lender says it's going to take 5 days to underwrite your application, we're not going to contact you every 2 days, because there will be nothing to tell you. So what I would expect is an advisor to contact you. Your standard timescales, every 48 hours you should be in contact, really. But if it's not that timescale, they should be telling you as and when they're going to be in contact and when they expect to have updates.
Yeah, absolutely. That's really important. Lovely. Thank you, Anthony. But somebody's written in, are there any disadvantages that I should be aware of when buying a shared ownership house compared to buying a house outside of the scheme? The sales office I visited last weekend couldn't think of any, but I'm keen to ask yourselves as the experts. I can't really think of any disadvantages. Can you, Tony or Helen? Excuse me.
I think there isn't really a lot of disadvantages, because it's a way of helping people to get onto the property ladder. I think where it becomes a little bit confusing, and I'm sort of picking up a few questions in one by saying this. A number of people think it's quite difficult to sell a property that's using shared ownership. Selling a property is all about the presentation of the property. And when I was working in the industry, I would often be going out to properties and the bed wasn't even made, the pots weren't washed. that's all simple things, but the presentation of your home helps sell your home. And, you know, when it comes to pictures, you know, I got to the point where I started employing photographers as part of the service to actually go out and take pictures, because if you're doing them yourself, we were getting pictures back of the bed or the bath or the toilet, and you know that isn't going to sell your home. So there's elements of that to consider, and I guess we have an obligation. We helped people get onto the property ladder through affordable home ownership, and that means an assessment to make sure that you can afford. So the higher the share that you own in the property can make it slightly more challenging to actually find a buyer, because the bigger the share you own, the fewer people probably have that income to cover that. But having said that, if it got outside that nomination period, you are allowed to then go to the open market and sell the property through the open market. I don't see any other major issues with shared ownership other than those that, you know, obviously there is you have to pay the full service charge at the moment on the properties when you're buying a share, and particularly now where we're looking at the 10% share, that's you know, quite a substantial amount to consider. So you've got to weigh up everything as a whole, and have that conversation to understand that with people. But as I said at the beginning, it's helped thousands of people get onto the property ladder.
Absolutely.
I would just add on that. Sorry, Linda.
Sorry, Anthony. Sorry.
I just wanted to add is that, you know, I wouldn't really think it's a disadvantage because it depends on your circumstance. But if you buy on the open market, you obviously, when you go to sell, you'll have 100% of the actual equity of the property. So that's an advantage of buying on the open market, not so much, you know, a disadvantage of shared ownership. Yeah. But I guess it depends on, you know, where you want to live. Can you afford to buy on the open market in the location where you like to live? And then also how long you plan on living in the property for. Because if you're buying a home for long term and it's not an investment and you want to live there for 5 years plus, then actually buying shared ownership, you are going to have capital growth as long as the property market continues as it is. So you might be able to buy in London or in your dream location, but buy a share rather than moving further afield and owning outright.
Absolutely. So I think at this point, we should just discuss what staircasing is, because we've discussed how many minimum shares you can buy. But Helen, can you just fill us in about how the staircasing works?
Yeah, absolutely. And this term staircasing, it's in our industry, we really do love to use a term that sort of maybe alludes or metaphorically sort of connects to something else, or a bit of a sounded like a disconnect really. But it means that metaphorically, as I said, you're climbing the stairs to buy and own more of your shared ownership home through buying more shares. And it's quite simply as easy as that. Obviously, this will allow you to pay less rent on the unsold equity, or in other terms, the unpurchased shares. But there are associated costs every time you do this, and these costs are your responsibility. So such as the property will need to be valued by a qualified RIC surveyor, Royal Institute of Chartered Surveyor, and you should bear in mind that there will obviously be legal fees each time you staircase or you purchase more shares. Obviously, you can staircase through several means. Perhaps you've been lucky enough to win the lottery, or you've had a bit of a windfall, or indeed you are advised to remortgage your property for financial benefits. But either way, bear in mind that staircasing really works well when the market is less heated value-wise. Staircasing under the existing shared ownership standard lease in general terms is in multiples of 10%. And as a rule guideline, you're allowed to staircase up to 3 times. And without getting too involved about the new model lease, there will be greater flexibility for the sort of 2021-2026 affordable housing programme. My advice to any of our buyers would be to always seek advice and representation from your solicitor or your conveyancer, and really get to know what your lease encompasses. It might not be the most exciting bedtime reading, but it will really serve you in good stead. I think what I should add here is that there are certain products such as older people shared ownership, or we might say OPSO, that have a restriction on staircasing, which levies it at 75%, and also properties in certain designated areas, particularly rural areas, are often capped at 80% as well. And that's really to enable affordable housing to always be available to others that might need it in those areas.
Yeah. And you don't have to staircase. It's not absolutely.
No, not at all.
It's really your choice.
Absolutely. It's a personal choice. It's one based, often on financial circumstances, and some people choose to, and to be honest, many people don't. Absolutely.
Well, I'm really sadly got to say that we've run out of time, but there was one question that came in, which actually I really want to just say something myself. And this lady has said, sorry for asking, but I'm a single parent to 4 children. Am I still able to try to get on the property ladder? 100% you are able to get on the property ladder. It's very tough for you with 4 children being a single parent, but never give up hope. We have a sort of a slogan at First Time Buyer magazine: you can buy your first home, and there's always something for everyone. You just have to ask and question and look on the websites and find something, and then talk to a mortgage advisor, talk to some people, and find out what's available for you in particular. And I'd like to also draw your attention to the website for Shared Ownership Week, which is quite simple. It's sharedownershipweek.co.uk. So do go on there. You've got a lot of information, a huge amount of things that you will find interesting. I'm so sorry that we can't get through all the questions. We probably could have been on air for about 3 hours doing this, because we have really been bombarded. I hope you've enjoyed it though. And if you want to re-watch it, to take in a bit more about what we actually said, or get friends and family to watch it, you can actually still watch it on Facebook whenever you fancy. It will be uploaded and you can watch it again. So I'd like to really thank Helen, Tony and Anthony for giving up your time. And to everybody that's been watching, I do hope you've enjoyed it. Thank you very much indeed.